everybody. So in this sort of, I guess you could say series, section, whatever you want to call it, I'm going to be talking about, you know, the trading recaps and many different approaches you can use the way we trade. Before I do that, I just want to mention some things as well. But yeah, you know, like I said, there's going to be a bunch of stuff in here. So you may have seen my message yesterday, well, evening, and I had mentioned that, you know, we were going to start taking more trade recaps in terms of, like, you know, actually talking in terms of probabilities and psychological part of things. And I just want to prove to you that there's so many different ways, there's so many different time frames you can use for your entries. I'm going to show you so many different things, and I just explain it in terms of different targets, where you can close out the trade, how you can manage the trades in terms of whatever, where you put your stops. I want to explain everything. Now, like I said in the past before, you can use many multiple time frames. It's just what works for you. So, you know, you can use the daily POI and H1 entries. You can use 4-hour POIs and 15-minute entries. You can use 1-hour POIs and 5-minute entries. You know, you can use 15-minute entries and 15-minute POIs and 1-minute entries. You can use 5-minute POIs and seconds entries. So you just really have to find what suits your lifestyle. If you're more of an aggressive trader, you like to be on a lower time frame, and obviously you're going to have to use a lower time frame. Now, I still recommend marking up the high time frame because it's important to build the high time frame narrative and understand where price may potentially be heading and where it's at on a high time frame perspective, because obviously high time frame rules a lower time frame. So regardless whether you trade the high time frame zones or not, it's still important to be aware of. So it's all about awareness. And something as well, like I said, you can trade many different approaches, and this is what the whole series is about. I'm going to be explaining different approaches in the markets, and hopefully you can gain some value from it. And yeah, we'll just go from there. So in the psychology section in Discord, there's a bunch of PDFs you can go and download. There's some information in there. Like I said, there'll be more information added over time. But I recommend only a few traders. I don't recommend any of these technical chartists you see online. I only recommend the psychological sort of people who focus on the psychology. So, you know, you've got the likes of Tom Hugard. I'm going to be speaking about some of his stuff that he's written on his website and on his YouTube. I'm going to be speaking about that shortly. You also have, you know, the likes of Larry Williams. I wouldn't say he talks much about psychological things, but he's still a great guy to listen to. You got more like, you know, Dr. David Paul, Larry Pesavento, Brett Steenbarger. These are all, you know, Mark Douglas as well. The exercise, that's a brilliant video that's in there. So there's so many different videos and things, and I recommend you watch. So, you know, if you understand why the market works, because I'll explain the why in a minute and the importance of it, because that's how I think one learns. You know, I feel like if they can understand the why rather than the how, they'll be in a much better place, and I'll explain some more on that in a minute. But a lot of the people who are not profitable, they'll, for example, come in, take a course, right, learn the technicals, take a few losses and be like, this is not for me, move on to the next course. And those people will forever be in a loop, and those people will, unless they break out of it, I hate to say it, they will never be successful. Okay, you can usually tell a lot by people. You can usually, you know, I've worked with so many different people and so many different, you know, I wouldn't say students because I think of everyone like family, but you get the idea. I worked with so many different people, and, you know, their backgrounds and, you know, where they are today, and it's been fun. You know, you learn so much when you teach as well. I absolutely love it. I treat everyone as if they're my friend. You know, I consider myself a very nice guy, and you can usually tell a lot by someone, the way they speak to themselves and the way that they just act in general. You know, you can tell, you know, if pretty much what I'm trying to get at, if you have a low teachability index, you are not going to make it, right? You should always be a student of the markets. You should, you know, you should be easily teachable. If you want to make money, you want to learn, you need to put yourself in a teachable position, right? Put your guard down and be open to learn, right? Take criticism as constructive criticism rather than criticism, you know. But, you know, enough of me waffling on about that anyways. But like I said, credits to those guys like the likes of Tom Hugard. He's like the more modern psychology person. Like, obviously, you know, he's a trader. He's a full-time trader. He used to, you know, watch his retail traders trade for years and decades when he was working back. I'm not too sure. I think it's CMC Mark or something like that. He was working, you know, on a trading floor, and he watched us trade for years, and obviously that, you know, helped him as a trader personally. But he focuses a lot on his videos. If you go to his YouTube, he focuses a lot on psychology, and like I said, I give a lot of credit to him because he is a good guy to listen to, and obviously I want to share that with you guys because I want every single one of you to succeed. A lot of people wouldn't share it with you because they're selfish, and they'll just take your money for the course and they'll just leave you stranded. Okay, now I'm not sure if I mentioned this already, but you can, like I said, trade many different ways and be profitable, right? For example, Tom Hugard and Larry Williams, Larry Pesavento, Dr. David Poole, Brett Steenbarger, Al Brooks, they all trade separately to each other, right? They all trade differently, and that just goes to prove and it goes to show that you can be profitable no matter the way you trade. Obviously, you know, if you're doing something silly on the markets, then yeah, you know, you're probably doing something wrong. But what I'm trying to get at here is that it doesn't matter how you trade, it really all is in the mind, right? A lot of people come into certain courses and, you know, take a few losses. They'll think, oh, this strategy or whatever, technical analysis is not working. Let's move on to the next one. And they're just in a loop, and those people will never succeed unless they break out of that, right? As harsh as it sounds, it's the truth, unfortunately. And, you know, for example, Tom Hugard trades, you know, more of a breakout sort of style of trading, you know, whereas Larry Williams trades a COT report. And that just goes to show, you know, that you can be profitable no matter how you trade, as long as you, you know, have it in the mind. And if I just pull this up now, I don't think I'll be able to pull it up. So the why and the how. So like I said, some of these credits go to the bunch of people that I've mentioned already. So the why is more important than the how. And this is like, you know, I feel like if anyone wants to learn, they must understand the why of things. So if you know why something is happening, you're obviously in a much stronger position to solve the problem than if you don't know the source of the problem. If you understand the nature of the why, then you will begin to understand the nature of yourself. So once you understand your part of the trading equation, you can begin to tackle the real hurdle of trading, which is yourself. The lack of consistency in trading is not due to the software you are using. It's probably not because you don't know enough about the markets either. And it is not certainly because you don't subscribe to the Guru newsletter, and it is not because you are using the wrong moving average or the wrong setting on the MACD or stochastic, or, you know, these all different harmonic patterns. The lack of consistency in trading is not due to all that. The lack of consistency is down to one thing and one thing only. And I think you already know the why. You know that you are the weak link in your trading equation. Do you know the how? Do you know how to act in your own self-interest all the time? So I read something, let me put it up. I read something a while ago. It's in the Discord as well. It's a video in the trading tips section, I believe. And it's a video, and it says, you know, he's interviewing him, and he goes, where is it now? We have cave brains, we have medieval institutions, and we have godlike technology. That speaks to the same point on the fact that we aren't hardwired for successful trading. You must understand this. In fact, we are instead hardwired to run away to panic. Because who in their right mind, you know, the average person, you know, coming to the markets, you know, losing tens of thousands of pounds is a normal day for most traders, right? That's not a normal day for the average person. So obviously you got to understand that it requires a lot of mental strength. So I learned something a while back, years ago, that the human, obviously, it's important to understand that the human psychology is not made for trading, right? So obviously, if anything, it's the opposite. So when you backtest, and I wouldn't say if you're an experienced trader, obviously, but because when you're experienced, if you're one of those who backtest and you know you mark up your charts and you think you're going to buy, and then it does the opposite, I recommend you to just go and back test, right? And when you find a nice solid buy setup, just do the opposite. And I bet you it will work out more often than not. And it is true, obviously, if you're more of an advanced trader, then it won't work because you'll already understand how to backtest and things. But, you know, that's essentially, you know, how it functions. The human psychology is not made for trading. You know, in fact, it's actually fairly simple. However, people overcomplicate it a little bit too much. You know, sometimes you just got to really work on yourself. You know, once you understand a little bit of the technicals and understand the why things. You know, we understand that a simple breaker structure, for example, like, you know, we have this chock here, right? What caused the chock was obviously this zone, okay? Let's drag it out. Let's go set a buy limit on there, okay? It may seem simple, and theoretically it is, because obviously you're just seeing it there. Why can't you do that? Because it's simple, right? You follow your trading range. We follow the 3 candle rule if you're in the course. We have the high, we have the low, right? This would not be the low. This is the low. Okay, this is the one that broke structure as well with this huge engulfing body. Okay, so don't overcomplicate it. You know, stop looking for excuses. And just trying to make sure I've pretty much covered what I want, because there's going to be things I'm going to be talking about as well from time to time. You know, in these videos, like I said, I want to try and give lessons in psychology as well. And I will give you all more information in the Discord group as well, in the psychology section over time. So I think that's enough of me going on anyway. Like I said, if you have any questions from what I said previously, just let me know, send me a message. But I just want you to understand the importance of psychology, and, you know, that it is because from the second you open a trade to the second you close the trade, it's all based on your decisions. It's all based on your, you know, your thinking. It's all based on your emotions. So it's important to understand and master your psychology, essentially, as cliche as it sounds. So, like I said, in this one, I'll go over a trade review now. I'll show you the many different entry types, and I'll show you. Bear with me, guys. Okay, so as you can see here, okay, now we posted this one in the Discord yesterday, right? If we just follow structure, I'll put this tool on and I'll take this off, okay? So as you can see, if we just follow from this high, right, to this low, wick is not a breaker structure on especially the high time frame. The only way I consider wicks my breaker structure is on the 1 minute time frame. Okay, so as you can see here, this is not breaker structure, therefore this is okay. So as you can see, we broke structure here, we then create a new high. Okay, we then obviously, the rule of thumb is to always, like, you know, once you mark out the high in a bullish market, always go back, you know, backwards in time and find the low, and obviously vice versa for a down market. Okay, so as you can see here, we just follow this back. All that we're looking for is 2 candles to the right and left that are lower than or higher than the candle low on the middle one. As you can see, candle high and low. We then didn't break structure here, but we broke structure here. Okay. As you can see, we have the high, we go back, we find the low, which is this one, okay? So in terms of trading range straight away, you just have to adapt, to these trading ranges. Obviously, you want to find the zone that created the imbalance push. So I don't mainly trade from order blocks, but I mainly trade from the zones that's created the imbalance push. And I usually try and adapt with the order flow of the markets. Because as you can see here, you know, as you can see here, we're just following the trading range, and, you know, if you had marked out this high, this would probably not have been your low. This probably would have still been your low, or this low down here. So you'd be waiting for price to come all the way down here. I just keep getting a message. So as you can see up here, we then go on, we close above here, We go back, navigate the low, which is here. I'll try and speed it up, sorry guys. We then have a high, go back, we create a low. We then break out here, which we chock to the downside, so we're in a bearish market. And we then have this here, right? And straight away, we have a bearish chock, and we have our 4-hour high and 4-hour low. And as you can see here, we did not break below this low, we did wick below it. And this is the importance of closures on a higher time frame. I've all studied and backtested this myself personally. Okay, if this was a closure, then obviously we'd look to create, trade from the zone that created the order block, or from the break structure. Sorry, as you can see, it would be this one, and as you can see, it would have been violated. Okay. As you can see, we had already mitigated this. Right, we had already mitigated this. So the importance of a breaker structure is obviously we enter into a new trading range. Once we enter into a new trading range, we have a new point of interest. Okay, essentially like how we adapt to the market. So as you can see here, yes, we have this order block here, right? Well, not order block, but the zone that created the imbalance push. So demand zone. So we have this demand zone here, right? And obviously, as you can see, price didn't pull back to it fully. Okay, so we just move on with the order flow and mark out the new next high and low. Okay, so then we simply look to take a trade from the, you got to think in terms of probabilities. If we had a zone up here, well, then it's not as probable as that holding as the most extreme point, because this is the one that also you gotta look at what caused the breaker structure as well. So as you can see, we broke structure here. So what caused that? And it was this zone here. So as you can see, right, simply. This one pulled back. This one wouldn't be a zone, right? Because as you can see here, I don't know why I marked it. As you can see here, we have a high. We came back up, we wicked above it. If we had closed above it, this would be the high and we started to pull back. This would be the high and this would be the low. Obviously, we'd look to trade from here, right? But as we had, obviously, this didn't break structure, this didn't break structure, this did. Okay, so that's the importance of, breaker structure. We then obviously move on. We have a new high, we have a new low. So we come back and tapped into it twice. We then have a new high, we have a new low, and price is starting to obviously get a little bit choppy here, and obviously starting to range. And obviously, in terms of expectations, once price ranges, we can expect an impulsive move, aka expansion. Once price it's obviously expanding to the downside or the upside, or trending, we can expect the consolidation to occur or range in the market to occur. Okay, so it's all about expectations and things like that. But like I said, understanding the why is really important. And again, we look to take a trade from the zone that created a break. Now this isn't as a solid break as this one, because as you can see, this one created pretty a rather large move. So as you can see, 153 pip move it created, as opposed to this one broke structure, but we only created a 10 pip move. So when we go back and locate the low, is this an imbalance in the market? It's important to get disciplined with this, by the way, because if this was because as you can see here, right, there is a ever so slightly imbalance in the markets, and if this was not an imbalance in the markets, let's say for example this wick was up here, this would not be a valid zone. We would simply look to trade from this zone. Sorry, this zone. And why? Because this is the one that created the imbalanced push. Okay, but obviously this one would be. So we'd have this one marked. And as you can see, price obviously didn't come back to it. Here. We didn't come back to it. So we just adapt. And it seems simple, and it is. There's no need to overcomplicate it. Where is it? There we go. Okay. Oh no, I need my zone. We then create a new high. Like I said, this is nice, a strong push. We then look for the imbalance. There's no imbalance here. There is an imbalance here, however. Okay. So what we would do is draw this, drag it out, and as you can see, it respected it. Right? It failed to put in a new high, but like I said, you probably would have took a trade on a lower time frame and partialed out, stopped out a break even, or whatever the cause, or however you manage to trade, it's up to you entirely. But as you can see, the nature of what we're doing here has been respected. We then obviously chock bearish to the downside, so we can go ahead and mark this as a chock. Okay, and I feel like hopefully at this point you guys should be gaining some value from it, because I'm trying to walk you through what's going on in price and my thought process. And as you can see here, we chopped bearish to the downside. We then, okay, well, let's mark the low, okay? And obviously, now we're in a bearish market. We go back in time. We navigate the high, which is here, okay? Because the candle next to it and the candle right to it is lower, okay? Now, theoretically speaking, yes, we would take a sell here. So we would drop down to the lower time frame and look for your entries, okay? A lot of the people would have their high all the way up here, right? Because obviously the high is high, the low is low, or the swing high that created the break. But unfortunately, price never pulls back to it. Yes, it may pull back to it later on, but you're going to miss out on all of these moves, right? It's the same if you're still holding this bias down here. You're going to be waiting for God knows how long, okay? So you just got to focus on being in the moment. It's as simple as that. Okay, so obviously at this point, chalk is unconfirmed trend. So in order to see a confirmed trend, so this is where you can start obviously putting rules into place. So for example, if you want to see a true change in trend, you want to see that chalk and break a structure rather than just trading from the chalk, So like I said, just you got to find what works for you, and it's so important. I cannot stress this enough. And like I said, I'll be focusing more on that area, so with the help of that will help you. And as you can see here, we have got the low and the high. We then failed to put in a new low, okay? As you can see here, we did wick the low, but the power of understanding wicks is pretty powerful. So when it comes to wicks, think of it like a rejection, okay? This is a huge wick rejection. This seems like it's just sweeping liquidity, for example, from all this liquidity that's resting below here. All right, it seems like it's just mitigating something on the lower time frame. So obviously every swing point has liquidity underneath it, okay? So there'll be liquidity resting underneath this, so you can class this as our liquidity sweep, okay? And as you can see here, we're obviously still within a bearish market, so the probabilities decrease of this trade playing out is if we were looking for buys. I did mention yesterday in a 15-minute time frame, if we break above this high, and which I'll show you in a minute, then it's worth looking at long opportunities. Okay, so it's very important that you just think of probabilities. So even though like we are structurally bearish on a 4-hour time frame, we can take a buy position, no problem. Okay. As you can see here, we failed to put any low. We wick rejected the downside. Obviously we didn't close. This is the power of closures on a higher time frame. And as you can see, it's a great example of it. Okay, so what happens is when this huge wick closes, okay, a lot of people did wait for a pullback into this, and as you can see, it seems like it mitigated it here, to be honest, right? Because obviously the candle next to it, this candle could have opened, created a little down wick before moving bullish, but obviously, as you can see, the candle next to that then came down and lower than this candle before creating a huge high. So obviously, once we have wicked that 4-hour low, we can drop down to the smaller time frame. So what is the time frame of choice that we've spoken about earlier on in the video? Well, if it's a daily POI, drop to the 1 hour. If it's a 4-hour POI, drop to the 15-minute. And again, find what works for you. You may find that you want to go for an aggressive entry and go to the 1 minute of this 4-hour wick. You may find that you want to go to the 5 minute. It's all about back testing and see what works for you. For me, what works for me is going to the 15-minute based on 4-hour time frame. Okay, if you have a 4-hour sort of point of interest or something that's happened like this on a 4-hour time frame, then I will go to the 15-minute for my entry. Okay, so as you can see, we've aggressively wicked this low. I will just take this for now. So we aggressively wicked this low. Okay, a wick rejection to the downside, rejecting okay prices, potentially rejecting the downside. So then we go to the 15-minute time frame. And as you can see here, what do we do? Okay, well, we can just go and follow price. We know it's a wick on a higher time frame. It's just closed. And let's just go take a look. So I'll use this actually. Okay. So as you can see here, we're bullish. Okay. We then break to the downside, which is here. We then obviously look for the low, which is here. Like I said, you can backtest and see what works for you. You can bend the rules a little bit. Maybe you look for 2 candles. That's You know, for example, if you look at this here, you can look for 2 candles to the right of it that's higher than this one. Okay, so just find what works for you. I mentioned it all in the Discord. The information's there. Do we close below? Yes, we close below this here. And it's important to check with your broker as well, because for example, this may not be a breaker structure like a closure on the broker. So whatever broker you're trading with, I'd recommend using their chart, because obviously you're using their chart, so you want to be getting on their trades and things. As you can see, we close below it on this. I'm not sure what chart this is, but obviously we close below it, right? So we then have a new low. We then go back and navigate the high, and as you can see, it's still the same high. Okay, now watch what happened here. The power of that 3 candle method. Price respected it. Okay, you would never have, you know, if you didn't use the power of 3 and you used the highest high, the highest low, you would never have been in this position, right? And as you can see, just following this simple concept, it changes everything. Okay, it changes everything. That we then go on to break structure to the downside. Okay, so at this point we're very bearish. What happens? We wick on a H4, we chock on a 15-minute. Something's starting to add up here. We wick rejecting the downside on a higher time frame. We just flipped into a potentially bullish market on a lower time frame. So boom, I want to get in on the markets. Okay, as you can see here, we then chock here. Chock. Okay, keep it simple. We have a high, right? Go back, navigate the low. Okay, this is not the low. If this was the low, you would still be waiting for price to come down to this low. It may come down to it later on, but like I said, focus on being in moment, otherwise you're going to miss these swing opportunities or just movements. And as you can see, we simply just look to trade from the zone that created the break of structure. Okay, like I said, these little minor refinements here from these zones, I'd recommend you go into your broker's chart and just refine it on the broker's chart. You know, it's all right doing your charting on TradingView, but like I said, all brokers have slightly different price quotes and things like that. So it's important that you double check on your broker's, you know, chart. Now, as you can see, we pulled back down into this 15-minute demand zone. So we then want to go to the 1-minute time frame. Okay. Now on the 1-minute time frame, the chock is only valid once we really tap into the, you know, the high time frame zone. So as you can see here, this is like one bigger range, so like in terms of supply and demand, you'd have your buy limit set up there, whatever, right? And as you can see here, we tap into this 15-minute zone, not completely, but again, it's important that we adapt. You know, as you can see here, let's just go follow price. We'll start off from here. Okay, actually, let's start off from. Obviously, like I said, you can factor in other things like liquidity. So as you can see, we've got downside liquidity here, right? So if you were to trade from, let's say, this zone here, well, then there's a high chance of that failing, because obviously, you know, we have this underlying liquidity resting below. So as you can see here, we did sweep this low, and I'll show you something in a minute as well. So as you can see here, right, we have this here, and now remember, on the 1-minute time frame, we allow wicks as our breaker structures. Okay, we allow wicks as our breaker structures on the 1-minute time frame. So as you can see here, we have a low, right? We go back, navigate the high, which is obviously not there, which is here. Yep, we chopped here. We then obviously close below here. We have a new high, new low. We then obviously go navigate the high, which is up here. We still have the same low in place, so that's fine. So obviously we'd be looking to trade from here, but obviously, you know, we wouldn't, because we have the high time frame intention of price coming down to here. So as you can see, right, we then obviously break above, we have a new high, and we actually have a new low. But like I said, if you want to bend the rules a little bit, that's fine. You can still look for a potential reaction from, you know, a zone around here somewhere. And obviously, as you can see, we chock bearish. We then move to the downside. We have a new low here, right? We then go back, navigate the high, which is all the way up here. We then have a new low, which is here, and we have a new high, which is here. Okay, this is a great example of inducement. Inducement is just essentially being induced into taking early buys / sales, and this is a great example of that. So as you can see, we have a low, we have a high. price chocks to the upside, right? And as you can see, we came back down. If you had your stops a little bit, you know, larger, then that's fine. You'd obviously still be in this trade like this. If you had your stops, let's say, you know, around the equilibrium of the zone or below the 50-minute zone, you know, favoring the consistency within that, you'll obviously be in this trade as opposed to, you know, missing. And even that is still a big trade, you know, all the way up here. I'll show you the targets in a minute. And even from that, that's still a 5.62R, right? But here's the thing, right? Fear is your worst enemy, as we know, okay? So even if you did enter here and you had your stops too tight, okay, we know that if the true order flow is obviously what it is, and this zone should be respected. So we know if price can chock back bullish again, there's a potential of it going higher. And obviously, again, if you've been took out the trade, you should see that as a positive, because that's liquidity being swept. Okay, liquidity, aka retail stop losses. Okay, we are retail traders, but you get what I'm saying, right? It's our stop losses. As you can see here, right? Sorry, I was just looking up here for some reason. So as you can see here, even if you did take a loss, okay, is what it is. Journal it, get over it, move on to the next one. We follow our plan with discipline, right? We then go on. We have a new low. Right, again, we have a new high. Boom, there we go. Okay, we looked to trade from the demand zone that created obviously that break, and as you can see, it wasn't the order block that had it, it was this one. Okay, and there we go. So now you'd have your buys on here, stops below the structure, and we're now officially in the trade. So let's just go follow price. You can manage it multiple ways. I'm going to show you one way of managing it in terms of a structure. Okay, so what I would like to do is play the bar replay and have it slowly so I can show you live, but I don't want to be here for ages because it takes ages. Tiny little bit of drawdown is what it is. So what if you had the kind of confirmation entries? Oh, there we go. And that's a little bit too fast, isn't it? If you had camel combination entries, you'd enter here. So, okay. As you can see, we have a new high. I'm going to try and be quick at this. We then have a new high up here. Okay. We then have a new low down here. Right. I'm going to slow down because this is moving pretty quick and I want to go through it. As you can see here, we then break. We then have a new low. New high. Same low. Break above. Is the candle next to it? No. Is the candle next to this one? Yes. No, it's not. As you can see, this one's higher. Is this candle next to it lower? This one? Yes. There we go. Right. And there you go. Literally, look, this is a great example of why we do what we do. I'm not saying you'd obviously enter here. That's not what I'm saying, but it just goes to show the power of the way that we, you know, what we do. As you can see, we have the high, right? We have the low. So obviously this candle, wick, low. You got to look at the candle highs and lows rather than the bodies. So as you can see here, you have this wick low. The candle to the right of it and the candle to the left of it is obviously significantly, not significantly, sorry, but, you know, it's obviously above the low of the wick. Okay, so obviously this, you wouldn't trade from here, but as you can see, it respected the range, right? So there you have it. Let's get back into it, shall we? We haven't created a high just yet. We need to wait for a high to form. We have a new high there. We then have a new low. We can actually, you know, mark this up. If you want to stack into the trades, it's up to you. Okay, we're just flying to the moon now. We then have a new high. Same low. High. Oh. Same low. High. Yes. High. Same low. And here's the thing as well, when you follow, we'll just let price play out because obviously, you know, we still have the same low, so price could theoretically speaking, come back down to these lows, and if it did, we can execute down to here, sorry, but we're just stuck within this huge range now. If you don't see the range, it's essentially just here, guys, and this one. We'll just speed up price because it's taking a long time, eh? Okay. There we go. So we've broken above. So let's see the candle next to it. We're just waiting for the high to form. I can clear these now. But that's, you know, don't overcomplicate it. There's no point overcomplicating it. So as you can see, we have a high, we go back, we navigate the low. And I'm still in the trade, by the way, because I'm showing you the way you're managing it with this way of structure. High, low. And obviously, you got to understand this is how you stack your positions. You know, for example, every trading range high and low there is, you want to just try and find, obviously, in this example, the low, and obviously try and think what caused the break above the previous, you know, high. So this candle here created this break. So what we would do, if price was in this range still and came back to it, we'd simply look to take a trade. Like I said, it may come back to it later on in the future. We never know where price is going to react from. All we have to do is just follow a plan and let our edge play out. You know, it's as simple as that. I play this now. Yes. There we go. And it may seem a little bit boring, but like I said, if you're watching this video, you're going to gain a shitload of value from it. Same high. Same. There we go. Oops. And, you know, we do use wicks as our breaks on the 1 minute. That's something for you to test out as well. There we go. We have a new high. Falling behind it. It's important to stay disciplined. We have a new low. And eventually, what should happen is that the low will get taken. And the minute that it gets taken is the minute that we can look to obviously close the trade. Okay, sorry, I just paused it there because I skipped it. So as you can see, this is a break. Right. So this here is where you would close the trade, right? It's important to stay disciplined. Okay. Now, as you can see, we have a, you know, obviously we had this high. We had this high. Oh no, sorry, I've read it wrong here. We're still in the trade, sorry. Like I said, we have this high, we have this low. Okay. So what we want to do, yeah, I am right, sorry. So yeah, this is the high and this is the low. So as you can see here, as soon as price broken below this is the minute we'd exit the trade. Okay. In terms of risk to reward, pretty nice one. Okay. And obviously you may take partials along the way. You got slight commissions, you got fees, so obviously there'll be a little bit less. Well, significantly less if you take partials. I recommend taking partials because it's important to pay yourself, but then it's also important to stack your position. Because a lot of people, what they do is they'll stack to their losers when they should be stacking to their winners. And that's something that took a long time for me to click. And as you can see, you know, the trade will play out. If you're in the right trade, it will play out like this. And as you can see, 27-hour trade, 0.5. All that I've done is follow the rules that we had in our system. Okay, I've stayed disciplined with it. And it's important to understand this is a great trade. Right, it's a 15-minute POI and a 1-minute confirmation entry. Like I said earlier at the start of the video, you can have a 15-minute POI and a 1-minute confirmation entry. You just got to try and make sense of the higher time frame to for it to play out. So for example, if you look on a H4, what did we do? Well, we wicked the low, didn't we? So, you know, on a 15-minute time frame, all we had to do is, you know, we had that sort of bias that we wicked this low. So on a 15-minute time frame, we just sort of had to just look for, you know, a 15-minute demand zone. And obviously, you know, there's more to it as well. So as you can see, if I just put on the it is on, sorry. So as you can see here, right, we have the Asia session low. Okay, what happened? If you understand our Asia sweep approach, again, it's all about probabilities. We swept the Asia low, okay? We then came back up and we chopped on a 15-minute. So there's 2 confirmations right there. We have a 4-hour wick rejection, 3 confirmations right there, a 15-minute demand zone, right? So that's, I guess you could add that as another confirmation. We then have a 1-minute confirmation entry, right? And a 1-minute demand zone on which we took a trade from. So 5 confirmations right there, okay? So just try and think in probabilities, okay? And yeah, that's the way, you know, if you manage to trade in terms of that, you will close out with that much. Obviously, like I said, less if you take pauses and all that good stuff. But if you know, manage to trade with, let's say, you know, if you're aiming for a consistently 1 to 5, 1 to 10, whatever, that's fine. You'll obviously make that 1 to 5 within minutes. You aim for a 1 to 10, you make that trade within minutes. You know, obviously, like I said, these trades won't play out all the time. It's important to understand that, right? You may target the high. That's the 14.4R right there, okay, the 15-minute high. So however you do it is obviously up to you, okay? So you just got to find what works for you. There's many different approaches you can take. You don't have to follow just one entry model. Obviously, one entry model is fine. For example, if you look for 15-minute POI off you know, the Asia sweep as well, and 1-minute confirmation entry, and you manage it with structure, whoa, that's big. If you manage it with structure, you're going to be in very nice trades, right? And boom, right? Obviously, by the time you close it might be a little bit less, so probably looking around that much. So yeah, how you manage it is obviously up to you, but that's how you manage it with structure. Like I said, there are many ways you can manage it, so I wouldn't recommend it if you are, like, for example, you know, we are stuck within a H4 bearish range, so I wouldn't plan on holding the trade for too long, you know, because if we was in a bullish range, right, if this was like a chock on the H4 and we was bullish, I would look to target the H4 highs, and you know, it's all about expectational market structure. Then, you know, you're anticipating that this high will be taken, but obviously you got to be conservative about it, because this here, you know, yes, it may happen, but you just got to follow your plan, you know, because that's more of a gamble approach as opposed to, okay, we're in bear structure, have pragmatic expectations. So yeah, just see what works for you essentially, and that's pretty much it, guys. So like I said, this video, it is a long one, don't get me wrong, and all of them won't be as long as this, but I really do hope you take this information on board, and I really want to see some of you message me and say that I've watched it to this end. If you message me now and say that I've watched it to this end, I'll be very, very proud of you, you know, and I may even ask you a question, so make sure you prepare yourself, but I really want you to see watching these videos, guys, because there is a lot of value in it, right? Obviously, we have the course there as well for all the concepts to be learned. There's trade recaps on piecing it together, you know, the psychological approaches in terms of, you know, trading with an edge, and, you know, trading like a casino and what we can learn from them. So the information's there, right? You just got to take the information on board and get to work, right? So yeah, guys, thank you so much for watching. Like I said, any questions, just send me a message, but I really do hope you enjoyed this video, and that is a simple trade entry right there. Yes, it's a 15-minute POI. Yes, it's a 1-minute confirmation entry, but we also had other factors supporting this bias in terms of the Asia low sweep. We also had the H4 wick rejection. We had chopped on a 15-minute, so we were with the intraday sort of, you know, range, and it all just made sense. Okay, so like I said, guys, thank you so much for watching, and I'll catch you soon.